and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Thank you for joining me and my podcast. Hi, I'm Phil Grande, philsgang.com. Okay, today we're going to talk about a couple of things. No one wants to talk about savings. Why do you need savings when you got credit cards, right? Savings is important, and savings, not having savings, is destroying our country. But today, tech is getting, crushed. People are rotating out of tech and going into economy stocks. Why? Well, I'm going to explain in a moment. But first, let's take a look at tech this week, or last week, and this week. It's been very, very weak. And because of many reasons, but a big one, okay, is what they call a macro backdrop. Big fancy word, means nothing more than a whole bunch of bad stuff put in a bucket. Rates, they're worried about the Fed rate, they're going to raise the Fed rate. Yields, of course, yields are everything when you're trading. They're worried about yields. Inflation expectations are up big time. You can see oil is back up again over $80. This geopolitical issue we have is just, causing people to rotate out of tech. And another big reason is yields. Yields are really up there. Yields are elevated. People don't understand how yields work. For tech to be sustainable, yields have to be in the threes. That's right, in the threes. We're talking the 2-year and the 10-year in the threes. Right now, the 2-year is at 4.22. You know what that is? To get that down to 3%, what you'd have to do? The 10-year is at 4.8. It needs to be at 3.5. That's really bad. And when they're in the threes, tech is so sustainable. Tech explodes. Institution money gets in and stays there. They don't get out like they recently did. They pulled out of tech. Not all their money. They got a lot of money still in it. But they've taken a lot of the money they usually trade with during the day out, and they're on the sidelines. So today, money is rotating out of energy into tech. Out of tech into energy, just the opposite. We also see money is rotating out of tech to industrials, to utilities, to financials. In fact, the financials, if you look at Bank of America and JP Morgan, one of our biggest money makers, that's an interesting thing because banks are in trouble. But Bank of America and JP Morgan, the trend is fantastic. And as you know, before you buy a stock, you always got to find out the stock you're ready to buy, is it yield friendly? So if you're going to buy bank stocks, the first thing you look up is, well, where should yields be? And yields should be going up. So it's friendly. If you buy a bank stock and the yields are down, knowing you're doing that, you may get lucky for a few days or a few weeks, but eventually once the money stops going into your bank, that stock will turn around and find that yield and follow it and will crush you. So you got to be very, very careful. So the big thing that's going on too is some of these tech stocks, we're talking about tech getting crushed. Yes, they are. And because, again, when you have the 10-year and the 2-year dropping together, the banks hurt, industrials hurt, almost everything hurts. But again, some tech stocks, the chips, the semiconductors, we're finding there may be an opportunity at these stocks. You should follow us and find out, because these stocks we're starting to see where, remember, money, what always moves first when you're trading, any trader knows this, is the candlestick. The candlestick moves first, and that candlestick forms a trend. So if money's coming in that candlestick, then you're forming either an uptrend, which is good news, a bad trend unless you're shorting, bad news, or a sideways trend. So right now what's going on is there's some stocks that we're seeing money going into some tech stocks, and we're seeing that the trend is building to the upside. Remember, it's the money that creates the trend. It's the candlestick that's important, because the candlestick, it will tell us what's going to happen because it's the first to move in a transaction. And when you finish at night, when you're finished trading, you don't do it anymore, but we used to log every night, okay, where did this stock close? And every night, as long as it closed higher each night, then you knew your tech stocks were going to be sustainable. If they start closing lower at night, then you know the stock, the stochastic, is going to roll over. So the easiest thing about trading, you always can tell what direction your stock is going to go because of yield. So right now, the biggest problem is most tech stocks are in deep trouble, but there's a few tech stocks we think may break out and run, and especially short covered, but we'll see that in the future. But right now, again, we just have to wait and see. Now, everybody loves tech. We know that. They'll jump out of tech for a couple of days. They'll run to Coca-Cola and defensive stock, Clorox, and then the minute tech goes up just a little bit, they jump right back in. It's ridiculous. So, but for now, if you're in tech, I'd be watching my yields and identify if the stock that you're in, is it friendly? Okay, is it yield friendly? Banks are yield friendly if yields are going up. Semiconductors are yield friendly if yields are going down. You've got to know that first so you're not fighting against yourself. So make sure you know that. And then for now, we're seeing a lot of problems with stocks. And it has to do, nobody wants to believe this, with savings. That's right. People don't understand that. Savings is the backbone of our nation. And when savings is bad, it hurts tech. It hurts your tech stock. So right now, when you see a high savings rate, that's fear. When you see a low saving rates, that's confidence. So right now, nobody's saving. Nobody's got any money. So savings is the clearest signal of consumer confidence. When people save more, that means they're scared. They're not spending. When they don't save, that means they're confident. They're not scared. And the economy's doing well. Now, why savings matters for the market, especially tech, is because savings directly affects consumer spending. That's almost 75% of our GDP. Savings directly affects corporate earnings. So when you're trading stocks, everybody's looking for earnings, that earnings report. Savings, remember, affects corporate earnings, market momentum. sector rotation here, like now. Look at the sector rotation. Everybody's bailing out of tech, and they're going into other sectors. And no one ever talks about it, especially Wall Street. They don't want to tell you that. It's because nobody has any savings. Savings hurts. Americans used to save about 8%. Today they save about 2%. That's right. Savings have totally collapsed. And personal saving rates, let's say the percent of disposable income that American puts aside instead of spending, has collapsed. In other words, just think if someone saves $5,000 a month, and that, or I'm sorry, if someone earns $5,000 a month and they're saving $250, that's a rate of 5%. So when the savings rate hits 1.4%, then it means the Americans, okay, we're saving almost nothing, hardly anything. And so, again, that's where we are today. And that's one of the reasons your tech stocks are in trouble. But nobody's going to tell you that. Now, savings rate, 20 years ago, in the mid-2000s, savings rate hit 1.4% in 2005. 1.4%. Typical range in the mid-2000s was 3 to 6%. And 10 years ago, let's say 2015, 2016, pre-pandemic, normal savings was 6 to 8%. Today, today it's 2.8%, almost nothing. So again, we're well below a 10-year average of 7%. And that's really bad for the market, bad for earnings, bad for the stocks. It's bad. But, so what's destroying our savings? Well, first of all, inflation. And you can blame Biden for that and his team, remember? 9% inflation. All this crazy stuff he was financing, right? I mean, just inflation. So when prices are rising faster than wages, and that's what we're seeing, it's been doing that for years, especially under Biden, people are spending more just to survive. Now, housing costs, look at housing costs. Rent and mortgages are exploding. In the last 10 years, housing price, I think, what did we say it was up? I think it increased something like, in 10 years, almost, I don't want to guess. I think it was 55%. Willie, look it up. I don't want to give anybody a wrong number, but huge. Housing costs exploded. You can't buy a house today. You can't buy a starter home today. Debt, credit card balances at record high. Interest rate, how much? In 10 years? In 10 years, housing cost is up 95%. I said 50. 95%. That is nuts. And one of the biggest problems with why housing is up 95% because of the land cost, not the brick and mortar, the land cost. Because the environmentalists, the ones who run around with a granola bar and hugging trees, those dopes, unbelievable, the rules and the regulations they put in place. A developer could buy a raw piece of land. He could get his permit in 90 days, sometimes shorter. He could build his infrastructure out within another 90 days, up and running. In 6 months, he's up and running and selling building lots. Today, it's almost 5 years, 6 years to get a subdivision approved. That's why it's so costly, and that's why people are in debt. Credit card balances are at record high, interest rates above 20%. So I could go on and on and on. Children and education has gone nuts. Wages are stagnant. So savings, I just wanted to explain, savings has everything to do with stocks, what's going on with stocks. But it doesn't mean that you can't make money in the stock market if you play the stock market correctly. I follow 6 stocks. And when I pick one of the 6 to trade, so let's say it's stock A, before I trade it, I check to see if that stock A is yield friendly, lower or higher. Need to know. So if I'm buying banks, that means it is yield friendly if they go up. So if I'm going to buy the banks, I look at the yield. I know yield's supposed to be up. I have the edge because yield's up, and that is helping me support the stock. If you don't look at your yield, you're jumping into stocks and you're getting clobbered. You don't even know it. That's so important. So you got to follow those yields. And then the first thing you got to do is follow that candlestick, because the candlestick on your chart will tell you what money is doing. And every night you're sitting there and they tell you, oh, new high, new high. But you better look at your candlestick, because if you're doing well and you think you're doing well, but you don't realize all of a sudden every night is closing at a lower price than the previous night, the next night lower, the next night lower, that's destroying your stability. So you got to watch that. And then you know, okay, I got to do something. People don't understand any of that. So people just listen to the dopes on TV, these financial shows, and they follow them. And when they're trading and they see their stock going up, they have no idea. All they got to do is look at the candlestick and just every night identify if that candlestick, your stock's going up and up, but that candlestick all of a sudden, each night now, Monday night, Tuesday night, Wednesday night, each one of those nights it closed lower. Thursday night, closing lower. But yet, they're telling you how great the stock is. It's telling you the stock is not sustainable. It's going to turn around and come down. So again, trading is not difficult. What's difficult is fighting the wave of stupidity and financial engineering that keeps coming out of these TV shows. And that's the big problem, because nobody wants to listen. So they just want to follow. All they think is there's a hot stock out there. There's no such thing as a hot stock. That is stupid. There's no such thing. You got to be nuts. There's no such thing as a hot stock. Okay? It's all about money. You got to follow the money and the trend. And once you know how to trade and put those things in place to help you, to protect you, it's fun, and you'll be making money consistently instead of the 95 million, the 65 million people who are traders, retail traders. They're losing 85 to 95% of their trades every day. Even brokers give them a stock because they don't know how the market works. Okay, so I hope you enjoyed this today. All right, savings is very important to the stock market. People don't know that. So I'll see you on the charts. philsgang.com. Check us out.